Hey everyone, welcome to the Explainer. So, as business undergrads, you've probably spent countless hours learning what drives financial markets on paper. But today, we're stepping outside the classroom formulas and diving straight into the human mind. I am absolutely thrilled to guide you through a fascinating topic today: the psychology of investing. All right, let's just get straight into it. Picture the absolute stress of sitting there, head in your hands, just bathed in the red glow of a crashing portfolio. That is the reality of investing. It's highly, highly stressful. In your textbooks, financial models are perfectly logical, right? Markets are efficient, actors are rational, and charts behave exactly as predicted. But the real world? It's messy. It is deeply emotional. When your real money is on the line, all that perfectly logical theory goes right out the window. To get a grip on how this happens, here's our roadmap for today. First, beyond supply and demand. Second, finding your trading style. Third, the emotional roller coaster. Fourth, your brain's trading glitches. And finally, mastering the trading mindset. Okay, let's kick things off. Section 1, Beyond Supply and Demand, the mechanics versus the mind. Now, you already know the traditional drivers of market moves. We're talking about inflation, government fiscal and monetary policy, supply and demand, tech shifts, the external quantifiable metrics we love plugging into our spreadsheets. And yeah, for sure, these absolutely cause the market to go up and down. But here is the million-dollar question. What about your brain? Market sentiment is a massive driver. You can have the best, most mathematically flawed trading strategy in the world, and it can still completely fail for one incredibly simple reason: the human element. The actual person executing the trade gets scared or greedy or just plain distracted. Which brings us to Section 2, Finding Your Trading Style. How time frames shape strategy. Before we dive into how our emotions wreck everything, we have to look at the mechanical frameworks traders actually use. The market is basically split into 4 main trading styles, and this is largely based on time frames and how intensely you need to monitor the charts. You've got scalping, day trading, swing trading, and position trading. As future finance pros, you really need to know which arena you're stepping into, because each one demands a totally different psychological toll. It all comes down to typical holding times. Scalping means holding a position for mere minutes. You are literally glued to the screen. Day trading stretches that to hours. Swing trading gives you a little more breathing room. You hold for days or maybe weeks. And then there's position trading, the ultimate long game, holding for months or even years, where you rarely sweat the daily noise. The crucial takeaway here is that your psychological endurance has to match your time frame. A scalper needs instant, razor-sharp discipline, while a position trader needs the patience to completely ignore months of market chaos. All right, Section 3, the emotional roller coaster, the psychological market cycle. So what exactly happens when that discipline inevitably cracks? Well, as prices start going up, you naturally begin with some optimism, right? A little belief. But as those green candles keep stacking up, that rational belief morphs into absolute thrill. And then right at the market peak, which, by the way, is the point of maximum financial risk, you hit euphoria. You literally feel like a genius, invincible. And that is exactly when your logical trading plan is in the most danger of being completely abandoned. And then the market turns. It's a brutal downward spiral. That euphoria, it immediately turns to anxiety as prices dip. Then you hit denial. Oh, it's just a temporary pullback. But as it keeps dropping, logic just completely disintegrates into panic and capitulation, where you just sell everything to stop the bleeding. Ultimately, at the absolute bottom, which is ironically the point of maximum financial opportunity, traders are left with nothing but anger and depression. Logically, buying here is the absolute best move, but psychologically, it feels impossible. Why do we do this? Why do we buy at the euphoric top and sell at the depressed bottom? Let's figure that out in Section 4, Your Brain's Trading Glitches, Cognitive Biases in Action. First up on the glitch list is loss aversion. This is our hardwired psychological tendency to prefer avoiding losses over acquiring equivalent gains. It literally hurts us way more to lose $100 than it feels good to make $100. In practice, this means a trader will stubbornly cling to a losing stock, just bleeding cash, hoping and praying it bounces back, just so they don't have to formally click sell and admit defeat. Next is one you absolutely know from social media: FOMO, the fear of missing out. This glitch involves making decisions purely based on the fear of missing out on potential gains. Think about the whole meme stock craze. You see a stock rocketing to the moon, everyone in your dorm or on Reddit is hyping it up, and you impulsively buy in because you're terrified of missing the boat. That is entirely driven by social panic, guys. not fundamental analysis. Then we've got the sunk cost fallacy. This is continuing an investment just because of the capital you've already put into it, instead of looking at current market conditions. It's incredibly dangerous. You hold on to a terrible position just because you've already dumped $1,000 into it. Even when all the new information points to further losses, you stay in, throwing good money after bad, simply because walking away feels like a waste. And finally, there's overconfidence bias. This is wildly overestimating your own ability to predict the market and make profitable trades. It's that classic trap where you think you can consistently beat the market without doing the hard, objective research. You make 1 or 2 lucky trades, suddenly you confuse luck with skill, and before you know it, you are taking massive, totally uncalculated risks. Let's fix this. Section 5. Mastering the trading mindset. Achieving objective detachment. So, how do we actually stop our brains from sabotaging our portfolios? Mastering the market requires balancing several internal factors, kind of like pieces of a giant puzzle. You have to understand your own personality. You've got to spot your behavioral biases, like FOMO or loss aversion, in real time as they happen. You have to regulate your emotional responses, and you must completely insulate yourself from external social pressure. When all those pieces align, you trade based on your system, not your feelings. I want to leave you with this incredibly powerful philosophy from trading psychologist Mark Douglas. He said, if you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. That is absolutely crucial. True trading success as you move forward in your business careers comes from mastering your own mind, not just memorizing chart patterns. You have to become a completely objective observer of the market, entirely detached from the emotional swings of the crowd. So as we bring things to a close, it's time to take a hard look at your own financial habits. I want you to ask yourself, which bias is secretly controlling your trades? Recognizing the glitch is literally the very first step to fixing it. Thanks so much for hanging out with me for this explainer. But seriously, before you go, really think about it. Are you a victim of FOMO? Are you stuck in a sunk cost trap? Keep questioning your own assumptions, keep studying the psychology behind the spreadsheets, and I will see you in the next explainer.